joined on today's show in our February edition of It's Your Wealth by registered retirement consultant Jason Pollock. Jason, good evening.
Good evening.
How
Always
are
good to
things?
be here. Wonderful.
How's
as
life
always.
treating you?
It's great. It's always good.
Hey, never complain, never explain, right?
We're at the hump of the winter, right?
Right on, man. We're
It's only downhill from here.
only got a few more months before we can get the lawn chairs out.
Yeah, can't wait.
Hey, on today's show, we're going to talk about investment strategies when interest rates are on their way down. So, Jason, over the past number of months, looking back the last year and a half, we've seen interest rates climb to really all-time highs that we haven't seen in 25 or 30 years. However, we're starting to see interest rates slowly come down. Bond yields are coming down. So on today's show, let's talk a little bit about this. And you look at most investors right now, most Canadian investors, there is a ton of money sitting in interest rate accounts around this country. So just some quick stats here. Now, these are from 2022. We couldn't find a 2023 number. However, in money market accounts, money market mutual funds, so funds out there that have cash in it, basically, there's about $26 billion. High interest investments these days, high interest savings accounts, about $29 billion. And GICs as of 2022, $152 billion. So when you add up 26, 29, 152, that's about $207 billion that were sitting in these types of investments about a year ago, Jason. I can only imagine that number has probably doubled.
For sure.
So we can assume there's 200, 300, 400 billion dollars sitting there. And, the question right now is, what do I start doing? Like, what's the strategy when all of a sudden my GIC rates are coming down? What do investors do? That's the focus on today's show.
Yeah. Well, just to kind of backtrack a little bit, you talked about money market and high interest savings accounts and GICs. So just for those of you that don't know what they mean, money market funds are simply very, very low risk assets. They own their funds, and they own things like treasury bills, treasury bonds, CDs, short-term securities, some high-quality corporate bonds. But most things mature within 1 year, so they're very safe and they're very secure and relatively liquid. You mentioned high-interest savings accounts. That was very popular in 2023. As you mentioned, about $29 billion invested in the high-interest savings accounts. Those are exactly, again, what they're basically saying. They're simply offering a little bit higher interest rate than what your regular bank account or your checking account can offer. Most checking accounts are, if you're lucky, you're getting 1%. These high interest savings accounts in 2023, some of them were over 5% interest. So
quick off topic here. Yeah. My daughter has a bank account. I think she had a summer job. She had about $1,000 in it. Looking at her phone, and she says, "Dad, what's this 0.01 interest?"
0.01 cent.
So the bank gave her a whopping 1 cent.
There you go. Get her in the high interest savings account.
Pre-tax.
Yeah. And then, of course, the ever popular GICs. Those are guaranteed investment certificates. Exactly what it sounds like. It's a deposit investment sold by banks, trust companies, and they offer a guaranteed rate of return over a fixed period of time.
Exactly.
So most people know about those, but in the last couple of years, the money market and the high interest savings accounts have become popular. So
and Jason, you think about where we were 5, 10, 15, 20 years ago and where we are today when it comes to rates. Here's a quick stat here. Back in 2020, bank GIC, so back then, only 4 years ago, basically, if you came to a bank on January and said, "I want to buy a 5-year GIC," you're looking at probably getting 1 to 2%. Like, they weren't paying very much, obviously. In 2023, if you walked into that same institution, either you buy a GIC through a bank or an investment provider, whoever it may be, those interest rates were 5 to 6%. Where are things going to go between 2024 now and the next 2029? But here's a interesting statistic here. Over the past 30 years, now this is as of 1990 up into 2020, a 30-year period, a 5-year GIC, the average rate of return was about 3.61%. So put it into perspective. Right now you're getting 5.5, 6%. The 30-year average is about 3.6%. And just a few years ago, it was 1.6, 1 to 2%. So where are interest rates going? We've kind of, tamed the inflation animal that we've been dealing with. Rates will come back down, and probably, my best guess is, we'll see those 5-year GIC rates go from 5 and 6% down to, historical norms in the threes.
Yeah, they're very similar to stock market, real estate. If things get out of control and you have these huge swings of big rates of return or negatives, eventually everything comes back to the mean. So you're probably right. We're probably going to see the 3.5% to 4% 5-year.
And GICs. 1 year might be back in the 2.5%. The 2 year, the 3 year. It's going to ladder up a little bit, but the good days are going to be gone probably sometime in 25.
Yeah, agreed.
Next year or so.
Agreed. But there are still some advantages to GICs and high interest savings accounts. Of course, the first thing is safety. You don't have to worry about it. You're getting a guaranteed rate of return on a GIC. The high interest savings accounts, yes, they'll fluctuate a little bit, but for the most part, they're very safe. Liquidity is with high interest savings accounts, you can be in and out. GICs are a little bit of an exception because you might be locked in for a year, 2 years, 5 years. Obviously, no risk of loss. A lot of GICs, or most GICs, especially the ones we offer, have deposit insurance, so you don't have to worry about one of the trust companies or banks ever failing. You're protected with insurance. And lately, in the past couple of years, we've had some pretty good rates of return, like you said, in the 5. Some of them pushed up to 6%. So we did have some good rate of returns for GICs and high interest savings accounts. But like you said, those things are starting to shift, or things are starting to change a little bit. So the downside is now the number one thing with this is the downside of all the GICs and high interest savings accounts. They're taxed at the highest marginal tax rate. So if you have a $100,000 GIC and you're making a $5,000 interest, you could be paying up to 50% tax on that GIC. So it's not always how much you're earning, it's how much is in your pocket. So just be careful about GICs outside of your registered accounts. Lack of liquidity, like I said, the GICs, sometimes they offer 1 year, 2 year, that you're locked in for those terms. Poor inflation hedge. So when inflation was running at 6, 7, 8%, and people were thrilled to get a 5% GIC, they were actually losing some purchasing power. Right. So it didn't feel like you were losing purchasing power, but overall you were losing 2 or 3%. And the final potential downside is risk of capital depletion. Again, if you're pulling out 6, 7% of your money, but you're only earning 4 or 5% on that GIC, it sounds like it's a great investment, getting 5%. But just be careful that your lifestyle might be a little bit higher than what you're actually earning.
Well, you know what? You made a great point about taxation on GICs. And, we're always saying to clients, if you're going to own a GIC, own it inside your RSP, earn it inside your RIF, earn it inside your TFSA. Those are the 3 places to grow your GICs. And the last part of the talk here today, Jason, is just some strategies. So you've got some people right now that have some money that they've been investing in these high yield accounts, GICs, whatever it may be, money market accounts, and they want to start getting back to the market, because what they don't want to do is the train's leaving the station, right? Like it's starting to head back down, and the question is, when do you get back on the train, right? Back into the market. So here's some consideration. One is, talk to your advisor, decide on your timeline within the need of capital. So if you have some GICs maturing and you don't need the money, then obviously, you could renew them again. If you do need the capital, you don't want to then lock it up for 5 more years and then realize in 2 years, wow, I wanted to take a trip around the world and I can't get my capital. So start to look at, the timeline of your capital. Number 2 here is, what's an alternative investment moving forward, right? Can we move it into maybe a stock, a bond, an ETF, a mutual fund? There are alternative options out there for GIC investors. And, again, we may be heading into a period where GICs were up here, the market was down here for a little bit, and things go in cycles. Things are cyclical, right? So right now we're seeing, 2023 was a really good year for the stock market, was a pretty darn good year for the bond market. Mutual funds did well, ETFs did well. So, you're seeing balanced portfolios in 2023 doing, 5, 6, 7%, not severely, but they're outpacing a GIC return. Number 3 on some of the strategies getting back into the market is, do you do it in a lump sum all of a sudden at once, or do you dollar cost average back in? Do you start putting money back in over a period of time? I've had a few clients call me, hey, David, I have $100,000. I want to get it back in. The strategy for us might be is let's start to kind of tiptoe back into the market over the next few months. Number 4 here is consider the tax efficient investment structures with new deposits. So what does that mean? When you're in a GIC, like you just mentioned, like it's treated as income. It is the worst taxed asset you can possibly invest in, right? Whereas though, if you get back into maybe a mutual fund portfolio, a stock portfolio, there is some tax efficiency inside those accounts. And the last key thing here on some strategies when it comes to getting back into the market, don't try and pick a date or a rate to bottom out. So, it's hard to say, I'm going to just wait, and then jump back in. It's difficult to pick the right time to get back in. Market timing is impossible for the greatest investors in the world. Even guys like Warren Buffett, the greatest investor of all time, would say, it's hard to pick a bottom or a top. So again, look at your timeline, look at what your goals are from a need perspective, a tax perspective. Talk to an advisor, get some good advice, get some insight, and hopefully you can slowly take your winnings from the GIC years and convert those winnings into different asset classes moving forward in 2024-25.
Yeah, it's time to get back in the market.
Yeah, you know what? I mean, I don't have a crystal ball, but however, there's a lot of positive momentum that.
And if you've got that long time frame, then
you'll be fine, right?
Then you'll be fine.
Yep. Jason Pollock, again, thanks for coming on to It's Your Wealth. Have a great evening.